Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
The past 10 years have been brutal for stock pickers. Very few have beaten the S&P 500. This fund manager thinks that's all about to change. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce with my co-host Ren, and today we're going to hear some ideas that challenge your conventional investing wisdom. Ren, good to be with you.
Right, good to be with you. Very excited to get into the conversation after that tease. What conventional investing wisdom are you going to challenge today?
Well, Ren, perhaps that Pokemon trading cards are an investable asset class.
Okay. Well, to be fair to our guest, he doesn't make that case.
Okay, good.
But we are going to do a deep dive on Nintendo, the stock.
Yeah,
and
nice.
The tie there is they own the IP
Yes.
for Pokemon. Bryce is pop culturally challenged, so I just wanted to make sure he got that. But yeah, we are challenging some conventional investing wisdom. We will hear why traditionally over the long arc of stock market history, stocks that grow revenue and profit faster don't necessarily grow share price faster. So much for earnings drive share price.
Yes, absolutely.
But look, to take us all through it, we're going to be speaking to Eric Marais, who's an investment specialist at Orbis.
Now, before we launch into it, a huge thank you goes to our launch partners, Milford Asset Management, Orbis, and SIBO. Today, in particular, a special thanks goes to Orbis.
Let's take a quick look at Orbis. For over 30 years, they've been focused on finding global stocks that are undervalued or overlooked by the market. Their approach is all about the long term, looking beyond short-term performance to identify companies with real potential.
With a team of over 60 investment professionals worldwide, Orbis sticks to a contrarian investment strategy. Managing over $60 billion in assets, their focus on value can offer a great way to add diversification to client portfolios, especially in today's ever-changing market.
Love it. Well, thanks to Orbis and all of our launch partners for helping us get Basis Points off the ground and helping us keep all of our content free. But Bryce, with that said, let's get to our conversation with Eric.
Well, Eric, welcome to Basis Points.
Thank you for having me.
Many listeners might not be familiar with Orbis, so can you give us an introduction to the history and also, importantly, some of the track records?
So I think, we're not very well known. With that said, we've been around for a while, and the history of the firm is pretty colourful and interesting, if I may say so. So our firm was founded by a man named Alan Gray in 1989. But preceding that, he had founded another business named Alan Gray Limited, so named after himself, in South Africa. So he was South African. He started that business after having gone to Harvard in the US. And then he worked at Fidelity alongside like Peter Lynch and some other, now pretty famous investors that were there in that era. I think I might be wrong on this, but I think if you read One Up on Wall Street, Peter Lynch's very famous book, there's a little footnote that gives Alan a little shout out in
nice.
there. I think it was that one, which I thought was a nice touch. So he left that feeling like he wanted to bring professional investment management to South Africa. And South Africa at the time very much dominated by the large insurance businesses, the investing landscape dominated by insurance. So he set up that business, which was hugely successful. And then what happened is it was that era where apartheid was coming to an end in South Africa. And Alan had earned the trust and confidence of some clients in South Africa, who then, when some of the capital controls around the country were starting to be lifted, asked him to invest some of their money offshore. And that's what led to the founding of Orbis in 1989. To make it even more confusing, so we've got kind of these two sister companies. So Alan Gray Limited remains a big business today. I think it's the largest privately owned asset manager in South Africa. We also have a business here in Australia named Alan Gray Australia. That business has had a presence here since 2005 or so. So you have the situation where in Australia, Allan Gray Australia invests locally in Australian equities and fixed income. Orbis invests globally, so offshore. And you've got Allan Gray Limited in South Africa that invests within that country. And we're kind of this group of three sister companies.
Nice.
So in terms of Australia in specific, we've been here since 2005 or 6. Orbis manages about 15 or so billion Australian dollars on behalf of clients based here. And together with Allan Gray Australia, I think that amounts to about $25 billion or so of Australian client capital. So we've been in Australia for a while, but we do fly under the radar. So
Nice. And how would you describe your investment philosophy?
We've got kind of three terms, three tenets to it. I think the third one's most interesting, so brace yourselves.
Nice.
The first is we're fundamental, and what that just means is when we look at a stock, we try to think about it as though we're going to buy the whole company and then hold it forever. And so we're not that fussed with exactly what the price is today or tomorrow. What we find is a lot of investors kind of playing the game of who's going to be the greater fool that they can sell a stock to, 3 months, 6 months, 12 months down the line. We try not to engage in that. We try to approach that analysis around what a business is worth, bearing in mind as though we were going to buy the whole thing and hold it forever. The second is we're long-term. And so that just means, when we apply that fundamental lens, we assume we're going to hold the company forever. And so that means we care about the cash flows at the end of the day. And the third one, now I've built it up, so now I hope it's interesting, is that we're contrarian investors. That means that we're looking for opportunities that others are paying less attention to, things that are neglected, things that are sometimes controversial, though we don't necessarily seek that out. I think we'd prefer apathy. But those things that others are spending far less time on, things that don't have the kind of attention on as the Magnificent Seven and some of the other very, very large stocks out there have today. That's where we tend to focus our efforts. So those three pieces, fundamental, long-term, and contrarian, kind of form how we invest. And that's true for Orbis. It's also true for Allan Gray Australia. It's also true for Allan Gray Limited.
Well, Eric, we'll dig into the investment philosophy, particularly the contrarian side, a little bit later. But just to close out in the intro to Orbis, how does that philosophy then flow down into products available for advisors here in Australia? And I guess what does that translate to in terms of performance as well?
Yeah. So we're not a firm of many strategies. We kind of want to pick our spots. There's a few things that we think we do reasonably well. And so we want to remain relatively simple as a firm and make sure that we can give those particular investment strategies the time of day. So in Australia, essentially on the Orbis side, there are 3 products that we've got available, 3 funds. The first is the Orbis Global Equity Fund. That's our flagship product. So that is actually the most important investment strategy for us as a firm, with a little bit under 60% of the total firm assets in that one investment strategy. Then we've got our Orbis Emerging Markets Fund. That one's really interesting. It's quite a unique, fascinating kind of application of the contrarian philosophy to emerging markets, which has some nuances, because I think those countries can sometimes come with their own pretty idiosyncratic risks and opportunities. And then we also have the Orbis Real Return Fund, and that one is a bit more absolute return focused with an inflation benchmark. What we think makes that one interesting is it's got some really fascinating tools in the toolbox that are not always available elsewhere, things like hedged equities, commodities, and so on.
So, Eric, I think you're being a little coy. Bryce asked about track record and you didn't want to give yourself a plug, but I'll give you the plug. Your fund, the Global Equity Fund, has beaten the benchmark since inception. I'm just looking at your website here. Net of fees, 9.6% per year compared to 9.1% for the benchmark. So we appreciate you being coy, but I'll give you the plug. Now we want to turn to, I guess, the case for investing globally, because investors have really ridden the wave of US dominance, and you're investing globally beyond the US. So we'd love for you to make the case for diversifying into markets that might be seen as, less exciting or that are slower growing.
Yeah. So I think, I looked up the numbers this morning. So it's in a sense, depending on your perspective, worse or better than that, right? So you've doubled your money over the last 5 years. But if you look at the last 15 years, the S&P's returned 14% a year in US dollars. So a little bit better even in Australian dollars, right? So that means you've doubled your money, then doubled it again, and then doubled it again. Over the last 15 years, right? I think you're arguing against it. So that's pretty phenomenal, and I think that's been really the reality of US, in particular, cap-weighted investors, right? So the S&P 500 is cap-weighted, and so you're getting the full benefit of the Magnificent Seven kind of coming through there. So that's just, I think, a phenomenal outcome. I don't think anyone can kind of realistically argue against that. Intuitively, I kind of get this interest bordering on obsession with the US companies, and in particular the US tech companies, right? Because it seems so intuitive that businesses that grow, businesses that are innovative are going to deliver returns in future, the returns we're all looking for, right? So I kind of get it from that perspective. I kind of feel for people in our generation because things, it's not easy. Cost of living has increased dramatically, in particular housing. I think a lot of people feel like it's just quite hard to get ahead, quite hard to get to that stage in life where you can actually start saving meaningful amounts of money from your income and then investing that, right? And so I think that kind of has the risk of maybe leading people down a path to really go out there on the risk spectrum, start seeking risk a little bit more, maybe gambling a little bit on some crypto on the side or some meme stocks here and there. And so I think that's kind of a real risk that our generation and the generations that are going to follow ours actually are exposed to. So something to bear in mind. Now I got to say something useful about what else you can do, right? The silver lining here is that there are some other opportunities out there. But the first question maybe to ask is just, why is it even worth looking? So why bother looking elsewhere if the returns have been so good? And there's kind of three elements of bad news, I suppose. So the first piece of bad news is that there's no real relationship between how fast a company grows and what its stock returns, which seems ridiculous, right? It sounds really counterintuitive, but across a large sample of stocks, there's no relationship there. In fact, the relationship is the opposite, meaning companies that grow their revenues and profits faster tend to have lower stock returns. Right, so that's value having outperformed growth, and there's a 200-year history of that. Now, that kind of ended in 2018, so we can now have a debate around whether you think that's permanently changed or whether that's just a cycle, because there's always been a cycle within that 200-year history. Sounds really counterintuitive, but at the end of the day, the stock market's a discounting machine, right? So today, people are incredibly excited about some of the potential for these big tech companies, and so that potential, that excitement gets priced in, and it has an impact on what the stocks can return in future. Right? So that's the first kind of piece of bad news. I think the second piece is a large chunk of the 14% a year that the S&P's returned over the last 15 years has come from two sources of returns that we can argue about whether they're sustainable where they are today, but they're not going to be sustainable sources of return going forward. The first is margin expansion. So the S&P 500 already has record high operating margins. It is possible that just continues to go up. I consider myself a capitalist. Capitalism is a very powerful force. Big profit pools tend to attract competition over time. And so I wouldn't bank on profit margins just continuing to expand the way that they have necessarily. The other source of return that I think is probably not sustainable is just multiple expansion, right? You've seen quite a bit of multiple expansion. So today the S&P is at around 25 times earnings. It's been higher, so it's not yet at a record, unlike margins, but it's pretty close to the most expensive it's ever been. So again, it's possible that things get further stretched, things get more expensive. But would I want to bank on that if I was planning for my long-term financial health, like for my retirement? I'm not so sure. So I think those two added together account for on the ballpark of 6 or 7% out of the 14. Right. So if you take those two off the table, you assume things still go pretty well. Otherwise, you're looking at a significantly lower return going forward. There are other even less optimistic outlooks on valuation and what that means for forward-looking returns. I think one analysis we did that looked kind of interesting is we're trying to get the most long-term sense of valuations, and we're trying to go really broad as well. One of the challenges we have is every individual kind of metric out there has its strengths and its weaknesses. So, you wouldn't value Amazon based on its price to book multiple, and you wouldn't value a bank necessarily based on its revenue. And so we went really broad, so we had to look at 12 different metrics and just to kind of gauge where stock market valuations are today. And across the 12 metrics, we looked at 55 years of history. Things look pretty expensive. 91st percentile is where we came to. So the stock market's only been more expensive than what it is now 9% of the time, which really was just kind of this very brief window during the TMT bubble.
And TMT for people is really the dot-com bubble of the late 90s.
Late 90s, early 2000s. And then what's interesting about that analysis is you can kind of overlay what happened, what forward-looking returns looked like. Right? So you can see periods when the stock market looked very cheap, very attractively priced, and then you can look at what returns looked like, let's say, for the next decade from there. And other periods like that dot-com bubble period, late 90s, early 2000s, when the stock market looked more stretched. And you could see, what forward-looking returns looked like then. If you were to apply that analysis and you do kind of like a best fit of the valuation graph and try to gauge what that might imply for forward-looking returns from here, that implies zero-ish returns. So right around zero. And that's in nominal terms. So you're falling behind after inflation, right? So that was a really big piece of bad news. So, okay. So the first one was about the company growth and company returns not necessarily being related. The second has been about valuations getting stretched. The third piece, I promise there'll be three, is that sometimes there are other markets that one can invest in, right? So if you say, okay, you don't want to invest in the US for some of these challenges where the big stocks are very expensive and so on, you might look to other more exciting countries to say, okay, we can invest in some other high growth economies. But a little bit like that first piece of bad news, there's no correlation whatsoever between GDP growth and stock market returns either, which is another counterintuitive one. You might have noticed a theme at Orbis. We quite like counterintuitive things because, they can be quite instructive. So I think one example that springs to mind is over the last 10 years, China grew GDP at 7% or so per annum on a real basis, so after inflation. The Philippines grew their GDP by just 3% a year after inflation. But they had almost identical stock market returns of right around 4% a year.
Wow.
Right? It's quite a big difference over a 10-year period.
Yeah.
That's because there's lots of other stuff in the mix, including kind of the quality of the governance around businesses, how the government within that country behaves towards minority shareholders and that sort of thing. So I think those are some of the reasons why I'd be looking to maybe do something a little bit different, why I do something different. Because, as good as the last 15 years has been, it's really hard to bank on that again for the next 15.
Well, let's drill down on that third component there, looking outside the US, because it's so easy to get stuck in all of the media and everything that kind of comes around the US and particularly big tech, and we get in this bubble. What are the markets and the trends that you're seeing outside of the US that you think are sort of underreported or under-recognized?
Yeah. So that's kind of the frustrating part about, I think, today's kind of international shares opportunity set is it's hard to say there's this corner here that looks hugely attractive and it's all in on that. Rather, I think it's almost as much about what you don't own as what you do. So I think avoiding some of these more stretched, more expensive areas that there is a lot of excitement around, that view is certainly expressed in our funds. But it is kind of interesting to maybe we can make some observations, right? Just trying to look at the bubble from the outside in. I think one thing that doesn't get discussed a lot that seems quite striking to me and has changed over the last 3 or 6 months is that animal spirits suddenly seem like they're back. Everything from Trump coin, Melania coin. I think Fart coin now has $1 billion market cap. So that's just crypto. But we looked at this recently. It's interesting. Stock markets have an increasing correlation to Bitcoin. And I don't know what the causality there is. Is it more and more crypto investors getting into stocks or vice versa? I don't know, but there is a closer relationship there. So for those of us who've looked at kind of crypto as a way to diversify, get some hedging, I'm not sure at least Bitcoin necessarily serves that goal. But there's been all kinds of stuff, right? Jensen Huang signed a women's shirt on her chest at Computex, right? Not so long ago. You might have read about during the dot-com bubble, there was this Beanie Baby craze, right? Everyone went mad for those little plushy toys, right? And today we have Jellycat. And I don't know if anyone has kids or likes these things, but they are very expensive plushies. I got to say, they are quite nice. I've got 2 small kids. They each have one. But they are ridiculously priced. And it's fascinating to see how excited people are getting about these things. I was in London recently, and at the Selfridges, they have a whole experience where it's set up like a fish and chip shop, and they have these plushies in the sort of form and shape of fish and chips ingredients, and people are just mad about this.
Right.
And so it feels like animal spirits are back, and it feels like maybe post-Trump election, that really, really accelerated. So I think that's been kind of interesting to watch. And the other thing I think has changed is just the valuation piece, but we talked that to death already.
Yeah. So when you're thinking about investing globally outside of the US, how are you thinking about the risks inherent in the new Trump administration, tariffs and the like? How are you overlaying that sort of macro picture into your bottom-up stock picking?
Yeah. So I mean, you touched on it there at the end. So we're very much bottom-up. So all of our work's done at kind of the individual company level. At the same time, our portfolio managers do try to stay close to the latest news. You certainly don't want to have your head in the sand. I think at the same time, if you're obsessed about every Trump headline, it'll make you want to stick your head back in the sand pretty quickly. So you got to find a balance there. It can be a little bit hard to know what's worth spending time on, right, and what's really worth investigating versus the things that can be a little bit more fleeting. But what we think kind of clarifies things for us is rather than treating it on a top-down basis, it's all done at the individual company level. And so our analysts try to stay close to the news and try to factor in any latest news regarding things like tariffs at the individual company level to kind of update our assessments of intrinsic value. And we try to monitor it that way. But it's hard, right? This was a world that was already hard to stay focused in, I think, pre-Trump. I think it's now going to be more difficult for another 3.5 years or so.
Well, Eric, we're going to take a very quick break, and then on the other side, we're going to dig deeper into contrarian investing in a converging world. So we'll be right back.
Thanks to Orbis for sponsoring this episode of Basis Points.
Orbis has been investing in undervalued and ignored global stocks for over 30 years. They're interested in long-term potential rather than short-term performance, and their international team of over 60 investment professionals concentrate on unearthing companies trading for less than they are worth, rather than timing market trends.
Orbis has applied the same fundamental, long-term and contrarian investment approach since its inception and has over 60 billion Aussie dollars in assets under management. With the investment landscape rapidly changing and with valuations where they are today, Orbis's contrarian style and high value exposure can make it an effective diversifier in client portfolios.
So a massive thank you to Orbis for supporting the launch of Basis Points. Welcome back to Basis Points. We're here with Eric Marais, investment specialist at Orbis. Orbis is all about contrarian investing. So we want to dig into that a little bit more. What does contrarian investing really mean to you guys?
It's about looking for things that others are less focused on. It's about staying away from the crowd. And I must say, we don't do it because it's fun, because it's not fun, right? So I think you've probably heard the adage 1,000 times about, if you're investing well, you might be right 60% of the time, right? If you're doing a really good job as an active manager. So that means you're wrong 40% of the time, right? But how you feel when you're wrong, I think does matter, right? So if you're kind of investing alongside the crowd, you're knee deep in the Magnificent Seven, and you turn out being wrong, it's all right, because misery loves company, right? And at least you got some friends with you that are probably in the same boat. You can all have a beer together and talk about what happened. What feels much worse is if you go out on a limb and make a decision that goes against the crowd and you're wrong. And that happens to us all the time. And that just feels awful, right? You look like a real idiot because you've done something that others would conceivably easily say that was a silly decision. With hindsight, it's very easy to say that some of those decisions were poor. On the flip side, it can be really rewarding when they go right. That's what we're looking to do slightly more often than not. But at the end of the day, I think there's a deeper question here about why we have this approach, right? So that is our philosophy. Why do we do it? We do it because at the end of the day, we're just trying to find stocks that are undervalued. For us to buy a stock for less than what it's worth, somebody else has got to sell it to us for less than what it's worth. And that's not a normal part of human experience, right? Like people don't line up around the block just to give you bargains all day. So the most likely reason why someone might be willing to sell you something for a little bit less than it's worth is that there's been some kind of run of bad news. Something has gone wrong. It's a cyclical company at the trough of its cycle, or it's a great performer that's run into some kind of temporary problem. And that owner doesn't want to hold it through that challenging period. right? So usually it's those situations where someone has, abandoned the spreadsheets and run for the exits, and that's where what we're looking for. That's where we get interested. It doesn't always mean something is hugely controversial. Sometimes if something has just been forgotten, I think that can work quite well. And it's an approach that we hope will be enduring. We've done it since 1973, so the firm now has a 50-plus year history of doing it with exactly the same philosophy. We think it'll be enduring because it's very much a behavioral aspect, right? That's why we're talking about people abandoning spreadsheets and running away and how it feels to be wrong. It's because we're, as humans, I think, find that very difficult. So ultimately, it's a behavioral thing where I think being wrong and when you're out on a limb feels pretty awful. And so hopefully for that reason, it will be an enduring approach.
The last few years have been tough to be a contrarian investor because we've converged on fewer and fewer names, but those big US tech names have worked. You guys did some analysis that put some numbers to this convergence. You did a Monte Carlo analysis, which essentially replicated random bottom-up stock pickers. And normally you would expect, sort of an equal weight underperforming the index and overperforming the index if you're just picking stocks at random. But that wasn't the case over the last few years. Can you tell us a little bit about what you found?
Yeah. So I think you summarized the analysis well. The goal was to just sort of see what is the impact of a stock market that's been this narrow on active managers who, when they put together a portfolio, truly sort of start with a blank sheet of paper and build the portfolio that way. What we found was the Monte Carlo, the way it was set up is pretty straightforward, really simple. Essentially, 10,000 different combinations of 50 stock portfolios with every stock just selected from the benchmark. So then what we measured is what proportion of those randomized stock portfolios out or underperform the benchmark. Okay, so think about it as the proverbial monkey throwing darts at a dartboard. Maybe not the most generous to my industry, but that's sort of the baseline, right? And then we're just trying to gauge the impact of how narrow or broad a market is on those outcomes. And it has a massive impact on how easy or difficult it is to beat a benchmark. So over the last 7 years, we ran it starting from 2018 through the end of 24, because that's the period that these Magnificent Seven and the growth investing style really took off. So over that period, 18% of those randomized stock portfolios beat the benchmark, which is well below the roughly half kind of number that you normally see over long periods of time. It's quite fascinating to see it. It looked quite similar leading up to the dot-com bubble. And then in the years that followed, it almost flipped and became much easier as a little bit of breadth came back to the market. So it has a very material impact on how easy or difficult it can be for, let's say, skilled active managers to outperform their benchmarks. Yeah.
Now, I think you might have answered part of the follow-up question from that analysis, which is, what is your counsel to people who have ridden this convergence and ridden it well and now are quite overweight these big names?
Well done.
Yeah, maybe congratulate them. I think that's a good start. But I think at the end of the day, we probably care more about what's going to happen going forward than what's happened in the past. Right, especially for those of us still trying to save and still trying to build up our wealth ahead of what will hopefully be a nice, comfortable retirement. In some sense, it's not that hard to avoid some of these most expensive areas, even if you have a passive approach. It's relatively easy to access funds that invest outside of the US. It's relatively easy to access funds that are a little bit broader than something like an S&P 500 index. So even if you wanted to be in the US, there's Russell 1000, there's Russell 2000. There are passive options out there that point to the all-country world index as a benchmark, which is the broadest of the global benchmarks that are out there. So that means it includes an EM component as well as a developed market component. So there's lots of options for that out there. I think as an active manager, what's fascinating about what we see is there are opportunities even in expensive markets like the US. It just tends to be in places that not everyone is as focused on. So in particular, that kind of mid-cap range, everything outside of the very, very large companies today, there's quite a big disconnect in terms of valuation multiples between mid-sized companies and the very, very large companies. And you might think, okay, that's just the effect of tech. But it's not. You have a look at Walmart's PE. It's almost up there with Apple's, which is a little bit hard to imagine for both of them. So there are tons of opportunities out there if you take a more active approach. If I look at our global equity fund, So the benchmark, which is that all country world index. Okay, I gave the impression earlier that it's diversified, right?
No, I was going to say something, but
Okay, thank you.
You say it.
Thank you, right. So it's the most diversified, right? I stand by that statement. That doesn't mean it is diversified. It still has about 2/3 of its exposure to the US, right? Which is pretty striking. If you look at other common world indices, they would be even more concentrated in the US, right? So something like the MSCI World Index would have a higher allocation. The FTSE World Index would have a higher allocation as well. But that benchmark, the MSCI All Country World Index, 2/3 of its capital behind the US. In the Orbis Global Equity Fund, we have about 55% of our capital in the US. So now that's less, but it might surprise you that that's not lower. And the reason for that is we can still find things on a bottom-up idiosyncratic basis that look particularly interesting to us, despite the fact that the market overall looks expensive. And so I think in terms of what you do about this, the kind of passive approach is you can make allocations maybe not as concentrated in the Magnificent Seven in particular, or the S&P 500. But if you're willing and able to invest in active funds, then I think your options there are a little bit more broader, because I think you've got access to stock picking, and you can still find some appealing opportunities even in expensive markets there.
So Eric, that's a great segue into, I guess, closing out this conversation by bringing to light the contrarian idea with a couple of actual stock examples. So we want to go address sort of 3 points. Firstly, what the company does. Secondly, the market's view on the company, and then I guess Orbis's contrarian view on it. You've got two for us today. Let's start with the first one, Nintendo. So for those that don't know what Nintendo does, what does Nintendo do?
I was hoping I wouldn't have to explain. That's the whole reason why I picked Nintendo.
Bryce is not a big pop culture guy, so
Okay.
Nintendo what?
So Nintendo. So I'm a huge nerd, so I do not think I'd have to explain what Nintendo does. But Nintendo's a gaming company. It's one of the most famous gaming companies, up there with Sony's PlayStation and kind of Microsoft's Xbox. In particular, they're very well known for quite creative kind of hardware designs, as well as very strong intellectual property on the game side, right? So they make their own games. They have their own intellectual property. If you haven't heard of Mario, I'm not sure I can help you.
All good.
But that's kind of what the business does.
Yeah, well, I mean, we should say some more, like Mario, Pokemon, Donkey Kong.
Exactly.
You heard of
I
these,
remember
Playing.
playing 007.
Is
Back
that
in the day
Nintendo?
on Nintendo, yeah.
Yeah.
So it was on Nintendo, and I think the movie also helped. The Mario movie that came out when was it 23? Might have seen that. That was a good movie.
Yeah.
Highly recommend it.
Yeah. So what's the market's view, and then where's the contrarian view?
Yeah. So today is quite a meaningful position in the Orbis Global Equity Fund, but we built the position in 2023. The reason why I'm giving that context is because I think some things have happened since. They've actually announced their latest console, which is the Nintendo Switch 2. But at the time, that was very much still down the pipeline. It was unclear exactly when it was going to happen or what it might look like. But the reason why it was out of favor, the reason why it attracted us as contrarians, is because the stock had performed incredibly poorly for a very long time. So it's done much better recently, but between 2008 was the stock's peak. It took them up until 2024 to exceed their peak again.
Wow.
Right. So that is a long grind.
Yeah.
And those are the kinds of things that we sometimes find interesting. The underlying reason why the company performs so poorly is really just its own kind of fundamentals. And that leads us to maybe the biggest risk with Nintendo, and very much the market's view, where the market focus is. And that's that the company has never in its history strung together two successful generations of hardware, right?
Wow.
So the Switch that's out today has been hugely successful, but prior to the Switch, the company had the Nintendo Wii U, which any gamers who are listening in will know exactly what I mean. That console was a complete disaster, complete failure. And the company performed horribly during that period. Prior to that, though, was the original Nintendo Wii, right? And that was hugely successful.
Yeah, we had a Wii tennis, Wii bowling. I remember that. Yeah,
right. So that kind of popularized the motion control, and hugely popular with people with families as well as like more casual gamers. So just performed incredibly well. But then they followed that up with the Wii U, which was a disaster, and then came the Switch, which was really good.
Yeah, I mean, you can even think further back, like Nintendo 64 crushed it, and then it was like the GameCube or something after.
Yeah, that's right. Okay, I had Segas growing up. Okay, so I don't know the history as well as you do, but I do know.
GameCube.
Yeah. So they've had this boom bust history, right? One successful console, and then the next one seems to be a complete disaster. And so, over the last few years, you were kind of in this window where everyone knew, with the Switch getting older and older, that they'd be coming up with something new. So now you're in this most risky part of the business's kind of history, because now they've got to come up with a new generation of hardware. What are they going to do? You know, will they finally kind of break that pattern, or will it be the same thing, right? That the Switch successor, we now know it's called the Switch 2, would make some sort of hardware innovation that would be a flop. So that was the key risk that was on people's minds. And so when we looked at the stock, we tried to do some analysis. It's almost impossible to just look at the company's current earnings to get any insight out of what it might be worth as a business, because over the last several years, this Switch generation has sort of been coming to an end. And so you know that there's a cyclicality in their profits, and you know that they're kind of on the tail end of monetizing that generation. So you have to look ahead and try to gauge what normal might look like for the company, right? A normal long-term through the cycle look at their earnings potential. And so when we did the math, we said, okay, what if the company doesn't achieve any miracles, but are somehow able to string something together here where they get a reasonable outcome with the Switch successor, right? Kind of a long-term average of units sold over their long-term history. On that basis, we thought that the shares were trading at around a mid-teens multiple of that earnings power. It's not screamingly cheap, right? There are businesses you can buy out there for less, but it's also hard to overestimate how valuable this company's IP is, right? They're just not going anywhere. I think 40% of the top 50 video games of all time are Nintendo intellectual property.
Wow.
Right. We saw how well the Mario movie did. The company's being very intentional about monetizing its intellectual property more. And I say that to just say the business is very valuable. And so when you can buy something like that, something with that much history, with that much intellectual property behind it at a kind of mid-teens multiple, steep discount to the market, usually that's not a bad setup. But now the question is, would they actually be able to string together two somewhat successful hardware launches? Because that would be breaking the mold of their long-term history.
So has it launched, Switch 2?
Hasn't launched, so we don't know yet, right? That's the honest answer. What we do know is that their approach with this hardware is very different from prior generations. So it's very much an evolutionary change to the Switch 2, whereas with every prior generation, they made far more material changes to the console's hardware, which is very difficult for third-party game manufacturers to work with, to make use of those technologies, like motion, for example. And so with that evolutionary approach, we think it's much more likely that they'll be able to put together something successful with the Switch 2. One of the other key elements around that is because the hardware is evolutionary, not revolutionary, it means they can maintain backward compatibility. That's really important for two reasons. One is they can continue monetizing the older games and selling them for use on the newer console. The other is they've now built quite a meaningful business around just online subscriptions. So if you want to play a Nintendo game online with your friends, you need a subscription to Nintendo's online game service. They've built a pretty large subscriber base in there, and that's a quite valuable, recurring, very consistent stream of revenue. And by doing this evolutionary approach, they can retain that entire subscriber base as part of the Switch 2. So that should smooth over that transition.
So you bought in 2023. In that time, you would have doubled your investment, or close to it. It's been a good couple of years for Nintendo.
To be clear, we've added to it a bit along the way, so I don't think it would be a double on the basis of a whole thing. That would be a little bit generous to us. But that's when we started building the position.
I appreciate you not just taking it.
I don't put my hand up.
When do you start thinking about we have a position that is perhaps no longer as contrarian as it was?
Yeah. So that comes kind of to sell discipline. So we're very focused on what our estimate of intrinsic value is. And then the way we tend to approach things is we do trade our positions around what we think intrinsic value is. So if something is nudging up against intrinsic, we tend to sell some and turn it into a smaller position. With that said, we don't turn the portfolio over all that often. We look at our turnover in kind of two ways, and there's quite a big difference between them. So the most common way to look at portfolio turnover is that statistic, which is just based on your trading activity, how often would you end up with a completely fresh portfolio? That number for us is quite high. We're turning the portfolio over once every 2 years. But then if you look at just the number of new names coming into the portfolio and exiting the portfolio, we're only doing that once every 3 or 4 years. And so we tend to hold on to things for quite long. In the case of Nintendo in particular, one of the other elements of the thesis that I didn't quite get to is businesses that are more stable, reliable, have steady flows of cash, as opposed to businesses that have this boom bust kind of model, tend to attract higher valuation multiples. And so that was kind of a blue sky element of the thesis to say, if they're going to follow a more evolutionary approach, if they're able to monetize their IP through more movies, theme parks, things like that, if they're able to slowly but surely, gently transition over the subscription base for Nintendo Switch Online to the Switch 2, it should result in a company that's got a much more consistent, stable earnings profile. And that, I think, can have quite a material impact on a company's earnings multiple. So whereas before we were looking at kind of 15-ish times this very variable, highly cyclical stream of earnings, most investors would pay a premium on that for something that's a little bit more consistent. And so our estimate of intrinsic was quite significantly higher than where the stock price was. But in essence, the way we do it is we revise our intrinsic value estimates at least once a quarter, keep an eye on where the price is relative to that, and kind of trade accordingly.
So, Eric, to close out, there was a second stock that you bought, which was Corpay. So let's start from the top again. What does Corpay do?
Yes, I thought this might be an instructive example because earlier I mentioned that we are still finding some US companies interesting, and Corpay is a US company. They do payments, largely kind of business-to-business payments, but it's not likely to be one many people have heard of before. It's not like big B2C payments or consumer-to-consumer payments companies. Mostly what they do is they work with businesses that have employees that are out in the field, and those employees are spending the company's money. So the classic example would be like a landscaping company, right? So you might own a landscaping company, you might have 10 drivers out on the road, and the owner of that company needs to keep track of how those drivers are spending money to, let's say, refuel with petrol, diesel while they're out in the field. So what Corpay would do in that situation is they would issue a card to the landscaping company, or series of cards. Every driver gets one. Those drivers then have to use those cards to refuel with petrol or diesel within a designated network of filling stations. Okay. The reason why that's an interesting business is it kind of forms like a two-sided payment network where, let's say, the landscaping company grows from 10 drivers to 20. Now there's more volume within that network, right? So more petrol is being consumed, and so the petrol stations are getting a better deal. Now Corpay can go and approach those petrol stations and perhaps negotiate a slightly better price on fuel specific for their customers, right? They'll take that price discount. Let's say they're able to negotiate an additional 2% discount. They'll take 1.5% of that discount and pass it directly back on to the landscaping company. So now the landscaping company gets a better deal, right? Because they're paying less for fuel. And on this little flywheel goes.
Yeah, it's interesting.
And a lot of great businesses out there are various forms of these kind of two-sided networks, right? If you think of something like YouTube, where this conversation will probably end up, the more people who watch, it makes it a far more attractive ecosystem for advertisers. The more advertising money that gets attracted, the higher quality content you get in, the higher quality content there is, it attracts more viewership, and so on and so forth. So Corpay has a variety of these little two-sided payment networks in its business. And it was built very intentionally that way by its founder, who still operates the business today. His name is Ron Clark. So I think, his involvement's been a very big piece of that puzzle. And the company's got a great track record. It's pretty phenomenal. It's right up there with the Mag 7. I think they've grown earnings per share by 19% a year since 2010.
Wow.
It's just a phenomenal business.
Wow.
So with that in mind and holding on the idea of contrarian ideas, like you've given us a pretty compelling case and a pretty consistent growth track record by the sounds of things. So where was the market's view that you saw an opportunity?
Yeah, so two things. Market was worried about two things. Remains worried about two things. The first is, although the company's got a great track record of long-term growth, it hasn't come in a straight line, right? It's been cyclical. So I use the landscaping company as an example intentionally because a lot of their customers are small, medium-sized businesses. And when the economy goes through a recession, the small, medium-sized businesses tend to fare worse than larger corporates. And so there's been this overhang around this recession that never seems to come for quite a few years now. And so the overwhelming concern is, okay, they've got a SMB client base. What happens to that in the event of a recession? The company in the past has managed that quite well. Tends to be that their revenues do drop quite materially, but they're also able to reduce their expenses to help offset that. It's not their first rodeo, wouldn't be their first rodeo through a recession, but the market can be quite short-term focused, and so you don't want to be investing in something ahead of a big recession that seems to be looming. I think that was a huge concern when we initially invested, but now with Trump and all this US enthusiasm, that's maybe faded away a bit. The second concern, though, is very much still there. And again, use the landscaping company as an example intentionally because about 60% or so of Corpay's revenues in one way, shape, or form touch fuel. Right? And so the worry is, okay, what happens in a world that's transitioning to electric vehicles? Right? Does that 60% of the business just go away? And so that's quite a longer term concern. So you got the short term concern about the cycle, you got this longer term concern about what happens to the business in that scenario. So that's the big risk. That's the thing that people are worried about. Our view on that has been twofold. One is that this transition to electric vehicles it's happening slower than what people might have thought. But most importantly, I think it's likely to happen much slower in the sorts of vehicles that matter for Corpay than the vehicles that don't. So we've seen a lot of EV traction in passenger vehicles, right? So cars that you and I might buy. However, what really matters for them is vans and trucks and heavier duty vehicles. And the traction there has been much slower because there's far more concern about that landscaper can't be sitting around waiting for an hour for the battery to charge. He needs to get to the next job. So until that problem is solved, and there are ways to solve it, don't get me wrong, but until that problem is solved kind of at scale in a cost-efficient way, it's likely that they'll remain quite dependent on traditional fuel. So that's the one piece. The other thing, and this is where the business is quite innovative, it's a fascinating little company. They're not standing still around this. So they've got some exposure in the UK, and almost as like a test case, they've built this business in the UK where they do have some clients that have transitioned to EV fleets that might be more important in places like London, right? Now, it turns out that introduces all kinds of other problems. So let's say you're the owner of that landscaping company, but all the trucks are electric. Your kind of best case scenario is maybe people don't need to charge at all during the day, but they can just charge at night. But now you've got a bunch of your employees charging their vehicles at night at their own homes. They might not have the charging infrastructure to do that, and they're certainly not going to pay for it. And they certainly don't want to pay for the energy costs of charging those vehicles. Think about what's happened to electricity prices. So it introduces all kinds of new problems. And so they've got this business that's really neat in the UK where they've kind of got a software platform and they provide the hardware to install at employees' homes, make sure that they can charge the vehicles overnight, and they ensure that the employees are reimbursed for the cost of the electricity to charge the vehicles. And it turns out that if you look at kind of the unit economics of that business, the profit that they make kind of per vehicle, so far that's on par or better than what they do on the fuel side. So we think they'll manage that. I think it'll happen. The transition will happen more slowly than what people think. But more importantly, they've got a plan. They're working on some really interesting things that over the very long run, if you think about kind of a 10-year time horizon, it's likely that they've got some solutions and can play a role even post-EV transition. So that's been our view. And the company's quite attractively priced, we think, around 14 times our estimate of kind of normalized earnings. For a business with that track record of growth, I think it's not that easy to find these days.
Nice. Two awesome examples, Eric. That brings us to the end of our conversation today. So thank you so much. I think firstly to you for coming on and I guess sharing your views on contrarian investing. I know a lot of advisors would have taken a lot out of that, but also thank you to Orbis generally for support of Basis Points and being our launch partner for the first year. So thank you very much.
Thank you. Thanks for having us. Appreciate it.
All right, well, that does it for this episode of Basis Points. Thanks for being with us. Make sure you subscribe wherever you're watching or listening so you don't miss any future episodes. And while you're subscribing to things, make sure to subscribe to the Basis Points email where we'll be sharing further information from these episodes. The link to sign up is in the YouTube description or the podcast show notes.
Basis Points is a product of Equity Mates Media. Basis Points is intended solely for industry professionals, financial advisors, and wholesale retail investors.
This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement and target market determination. And if you are unsure, please speak to a financial advisor. There are risks with any investments, including one in the Orbis fund. Past performance is not a reliable indicator of future performance, and the value of any investment in an Orbis fund is not guaranteed. This podcast represents Orbis's view at a point in time and provides reasoning on why Orbis has bought or sold a particular security for its funds. Orbis may take the opposite view from that stated, as facts or circumstances may change. This podcast does not prohibit the Orbis funds from dealing in the securities before or after this is published.
Equity Mates Media operates under Australian Financial Services Licence 540697.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.